Okay, hi Rishabh, Mr. Ramesh, you can start writing your questions. I hope all of you have studied something before asking me questions. Otherwise, there cannot be any meaningful discussion, I mean to say. I see more people are still joining us. So we will just begin the session with Shiva. Shiva, do you have any particular question? Okay. Hello Apurva, Mr. Manoj, thanks for joining us. Nice that we are having more participants. Guys, do you have any particular questions, or should I start showing you some topics on my own? That is why we actually upload the webinar schedule at least 1 month back, at least 1 month before we upload our webinar schedule on the website of Alien Markets. Under the ENCCMP tab, you will always find the schedule of the webinars. Why do we so? Actually, why we are doing so? So that you are knowing that whenever you are taking admission, you can straight away go to the ENCCMP tab and have a view when is the next webinar going to be and on what topics. You can accordingly prepare your questions also whenever you study. Hello, Dr. Abhijit. How are you? I remember you were also there in my last webinar. That's nice. Please keep on coming. Please keep on joining my webinars and ask me a lot of questions. Okay, guys. Then, since I'm not having any questions from your side, I will start showing you some data, and some. We will also be discussing some relevant points from the current market, from the current data. I mean to say, it's all going to be practical training. I will be making a lot use of this website called tradingeconomics.com. On the screen, I think you are able to see this website, tradingeconomics.com. It's a free website. We'll take some country specific data. Say we'll go to our country's India's data. This website represents in free a lot of economic data for many countries. You can almost find the data for almost all the countries. Although we will be limiting our discussion to a few countries like China, India and US, so that we can have a good comparison where do we stand. You can see on the screen our GDP growth rate is 1.5%, unemployment rate is 4.9. Again, this is as per the government. Inflation rate which they are showing, this is 2.18. Now what kind of inflation is this? This is the wholesale price inflation, that is wholesale price index. So coming back to this topic of GDP, just click on it and take you through the details. They also give you the statistics for different years, for different time periods. If you click on the 10-year time frame, what kind of GDP growth are we having? We are almost back at the same level around 2007, 2006, almost same level, maybe even a bit lower. So our GDP had exponentially grown in the year 2009, 2010. Our GDP was very high actually, because now it is down. You can see all the details here. India is the world's 10th largest economy. This is very important for you to know. Now, which is the largest economy in the world? It is the US. US is the first largest economy. I would say US is the largest economy, having a GDP of 18 trillion, and our GDP size is it is 2 trillion. Here you can find the value where my cursor is. I hope you are following my comments as well as the cursor movement. In the GDP you have written, you will find it in 2088. So if you convert it into trillion rupees, it is 2 trillion dollar actually, sorry, 2 trillion dollar. So the size of our GDP is 2 trillion and the US GDP is 18 trillion and China's GDP is 11 trillion. So where are we? We have a long way to grow. We have a long way to grow and we have a long way to go also, I mean to say. That is why we are only the 10th largest economy. Although in Asia we are the second largest economy, but on a world scale we are the 10th largest economy. And I think you will also be studying in your books, some of you must have studied also in the books, that what are the components of GDP. Components are this agricultural, forestry, fishing. This constitute around 12%. But there is also the manufacturing sector which contributes more than 15% to GDP. So unless the manufacturing sector in our country grows, it is very difficult for our GDP to grow in real terms at the same time while providing employment to the people. If there is no employment and there is only growth in the service sector, I suppose you are all very comfortable with the word service sector. Service sector means what? It means people who are employed into the BFSI domain, say telecom industry, IT industry, education industry, share broking, housing finance, insurance industry. All these are what? These are under the broad category of service industry, where there is no labor class actually people, where there are no labor working in the factory. That is the service industry. So service industry, although they contribute around 50% to the GDP, around 50-60% to the GDP, but the real job growth in a country like us, like our country, where there is a huge population, the real GDP growth can come only when there is a generation of employment opportunities on a large scale. So for that means, I want to say, for that to happen, manufacturing sector should grow. Otherwise, there cannot be large scale employment opportunities for the labor class people or for those who are not fit enough to work into the service industry. Everybody is not that skilled in India. Although we have a large population of more than 131 crores, but around 60% of population is into the farming. So they are not anyway contributing to our country GDP, because what all our country what all our country's governments and state governments are doing, they are waiving off the farm loans. So the farmers can enjoy, but we keep on paying taxes. So the onus lies on the rest of the tax-paying population, those who have PAN cards and those who contribute to the country's growth by way of taxes. The onus lies on us, the white-collar people. We are the white-collar people, or we are the service class people. We have to contribute to a GDP. So how can we contribute? Either by working in the manufacturing sector or either by working into the service sector. These are the main two sectors. I'm just trying to give you an idea what are the main three components. First, biggest component is the service sector, which contributes more than 50-60%. Secondly, you have the manufacturing sector, which contributes 15% to GDP. And thirdly, there is the agricultural sector, which contributes around 12%. These are the three main sectors of the GDP in our country. So until unless all of them are growing, our country cannot grow actually. Just have a look at the GDP growth rate. If you go to the Asia tab, it will show you the different countries' GDP growth rate. Just compare, where do we stand? Okay, let me show you comparison with the US. You click on the Americas tab, go down, US. What is the growth rate of US GDP? 1.2. Because US is already a giant. It has a huge base. Now what is the size of the base? It is 18 trillion. If they are growing 1.2 or 1.5 for that matter on a huge base of 18 trillion, that is not that big. But our base is already too small. It is only $2 trillion. On a base of $2 trillion, if we grow at the rate of 5% or 7%, that matters. I hope all of you are understanding what I'm trying to convey to you. Why is it important for us to understand GDP and what are the different components? Do you have any questions? Apurva, Mr. Arun, Dr. Vijit Bakshi, Manoj, Mr. Ramesh Chandra, Rishabh, anybody? Or should I continue with my topics? Because this is supposed to be a doubt clearing session. I do not want it to be actually a one-way session. I want you guys also to ask me any sort of question, please. Do not limit yourself. Okay, no questions, then I'll just take my presentation forward. We will study some more indicators. Here you can also see the data for the Indian currency. Now our currency is at a level of 64.44 against the dollar. So that means what? $1 is equal to 64 rupees 44 Indian rupees. So click on this tab. Again, it will take you to host of information. It will also show you historically when this data had reached its highest point and when this data had reached its lowest point. So let us click on this historical tab and say 1 year. If you click on the 1 year tab, on January 16, from January 16 until April 17, our rupee has depreciated. It had earlier depreciated in the first part of January 16. Then it started appreciating. Now the rupee is highly into appreciating mode. I hope all of you are clear with the meaning of this rupee appreciation. Is there anybody who does not understand this? Please ask me. Otherwise, I will just go on explaining, but you won't get anything out of it. Do you understand the words rupee depreciation and rupee appreciation? Vaishali, Shiva, Rishabh, please ask me if you have any doubts. Ramesh Chandra, Mr. Manoj. No questions? Okay, so that means you are through with this topic with of rupee depreciation and appreciation. Okay, so you can just see that our economy has an okay. Okay, Vaishali, I'll explain it again. What I'm trying to say, Vaishali, is that how our rupee has moved in the last 1.5 years from January 16 until today. You can say that roughly the time period is 1.5 years. So right in the beginning of 1.5 year time period, our rupee was at the level of 66, but then it went on to depreciate against the dollar to touch a level of almost 68 point something, a tad below 69 ka level against the dollar, because that time our economy was not that much growing. We were actually yet to implement the reforms. But after that, our economy started improving with all the Narendra Modi's activities, like bringing in the FDIs and FIIs to our country and get them to invest, to market our country as an attractive investment destination. The company's profits also started to improve. So the rupees also started to get stronger. Rupee getting stronger means what? Rupee appreciating against the dollar. So now you need less money. Now you see rupee has become 67 around this level. After that, it again depreciated, again it started appreciating, and finally now it is quoting at 64.44. Now you will need less Indian rupees in your pocket to buy one quantity of dollar. Earlier it was, say, 68 rupees you had to have if you went to convert it into $1, but now you need to have what? 64 point something Indian rupees in your pocket to buy the same quantity of dollar, that is $1. So now you need less Indian rupees to buy the same quantity of dollar. This is called rupee appreciation, or rupee getting stronger, rupee strengthening. Either it was a weak rupee or the dollar getting stronger, either way. Now is it clear to you, Vaishali? What do you mean by rupee depreciation and appreciation? I will just explain it again with the help of this Sensex. You can also go to this market tab, go to the stock section. You can find our Sensex being mentioned here among all the world indices. Click on the historical tab. Just see how our Sensex has moved in the last 1 year. The last 1 year, when the rupee was into a depreciating mode. Just now in the previous screenshot I had shown you, the rupee was depreciated 1.5 years back or 1 year back. It was around 60, it was around the level of 66 against the dollar. That time our economy was not doing that well as it is doing today. So Sensex was also down. How much was the Sensex level? Around 26,000 something. Now as and when the economy started improving, so the Sensex started reflecting the rupee trend. So what is actually rupee showing you? Rupee is also a reflection of the Indian economy. If the rupee improves, then our equity markets will start discounting that. Meaning our rupee, if our rupee improves, if our rupee appreciates against the dollar, then our Sensex will also start rising. You see already it has touched nearly 32,000 because our rupee is now much more stronger than what it was 1.5 years back. So you can actually expect the Sensex to be down or up if you learn to track the movement of rupee, and of course why it is moving so. You must be able to do the fundamental analysis of the economy. By that way you could have gotten here around January 16 or February 16 and made lots of money if you had stayed invested until now. You would have got it at the level of 25,000 or 26,000 and you would have made multiple many times returns. I mean to say double digit returns, because if you had entered at 25,000 level, now the level is of 30, 31, 32,000. That too within 1 year. That means a lot. It is actually a double digit return, isn't it? I hope all of you are getting the correlation between the Indian rupee and the Sensex. Rishabh, is it okay with you? Okay, gold price and stock price. Dr. Vijay, nice question. I would answer your question in two parts. One, uh, the gold price and the relation with the index actually. We are not going to talk about any particular stock, but instead of stock, we will be using the Sensex only. So let us go to the gold portion. Again, go to the market section, commodities. You click on this. Find the gold. Gold is there. Now this gold price, we are seeing it not in the terms of Indian rupees, but in terms of the international commodity, that is the dollar denomination. Just a minute, Mr. Bakshi. Apurva has a question. If the rupee is strong, then stock becomes expensive for FII. Then what do FIIs look at before investing? Mr. Apurva, actually FIIs, they look at a lot of things before investing. It is not only the rupee. Although we were discussing the rupee factor, FIIs, first of all, they look that has the company been growing strongly in the past 5 years or past 2-3 years. Growing means what? How do they measure whether the company is growing or not growing? They are looking at the earnings, that is known as EPS, earnings per share. Are you getting me? If in the last 5 years, say Maruti has grown at the rate of 20% per annum, in the last 5 years its EPS has grown at the rate of 20% per annum. So before investing, they will have a look, they will do all sorts of analysis to find out, to estimate whether in the next 2-3 years also will Maruti continue to grow at the same rate or at a lower rate or at a higher rate. Accordingly they will decide. It is not only the rupee. Okay, I hope I am able to clarify somewhat at your level. Is it okay, Apurva? Can I go ahead with Dr. Vijit Bakshi's questions? Hello, Apurva, are you there? Okay, you have a second question, you have written your answer only. The strong rupee good or bad for FII? Great. Uh, Say if the FIIs had entered into India when the markets when the rupee was trading at 69 level, that means when they had entered 1 year back or 1.5 year back, that means that time they had invested into India $1 and they got it converted into 69 rupees. But now if they invest into Indian rupees, now if they invest into Indian markets, now they will be getting lesser Indian rupees on conversion, isn't it? So if a strong rupee is there, if our rupee is strong against the dollar, then at the time of entry, FIAs will be able to convert less Indian rupees. But if the rupee is weaker, then they will be able to convert more Indian rupees. But that way it is good or bad. Are you getting it, Apurva? Okay, let us proceed with this question of gold and stock price correlation. My question to all the participants, can you just type out your thoughts or your opinion on this? Why do you think gold prices rise or gold price fall? What could be the basic fundamental reason factor behind a gold price rise or gold price fall? First, I would like you all to answer, including Dr. Abhijit. Demand and supply, okay, that is just one common reason. But what more could be? Aha, world economy. Dr. Abhijit has given nice answer. Price of alternative investment. You're missing out something, guys. Why would you go and invest into gold at all? Just because it is called gold, or just because our fathers and everybody around us has been investing into gold for last many centuries? Is it so? Is that all? It is not based on uses actually. Okay, just let me present the answer in a nutshell. Although the basic reason is no doubt about demand supply, but you see, gold is seen as a safe haven asset class. Whenever people see that there is a huge negative stock market correction, huge economic negative event like the demonetization. Remember, the demonetization happened in around November 2016. It was a huge economic event having a negative impact on all the stock markets, companies, on all the businesses. So for short period of time, if you remember, the gold price during those days of demonetization, it went up to 46,000. Somebody says 60,000 rupees in Indian rupees, I mean to say. From 40,000, it went up to 46,000 and 60,000. So whenever there is any kind of uncertainty, stock market crash, economical crash, big scams in the stock market, only then people start selling their equities and shift their asset allocation. They shift their equities money to the gold. So gold is largely used for parking the money whenever there is any huge correction in the economy. Correction in the economy means what? Correction in the stock market, of course. So stock market itself is a mirror for reflecting the economy. So you can see on the screen what I was trying to show you during the last 5 years. I'm using a 5-year chart. In 2012, our economy was just recovering from the after effects of recession of 2008. But the stock market was not that high as it is today. Today's market is 32,000. That time it was around 28,000, 27,000. So the gold was very high because that time people were not ready to invest into equities because equities is always risky. But gold is supposed to be what? Less risky. It is supposed to be a safe haven. Parking lot for parking of surplus money. Until unless the picture is clear in the other asset classes like equities and debt, until unless the investment picture is clear, people like to park their gold, people like to invest their money into gold for safety, just for safety, not for growth. Forget about inflation. You can see the gold was at a very high level of around 1800. 1800 what? This is dollar per troy ounce. Remember, gold is an international commodity. So gold prices, they rise whenever the what do you say, the consuming country's economy is doing very bad. I am using the word consuming country because we are not gold producers, but we are largely gold importers. We consume gold a lot. Every year we import 800 to 900 tons of gold. Are you getting me? We are a gold consuming country. So whenever our economy is not doing well, then people start shifting out from the equities into the gold. So gold prices rise. Although I'm showing you the dollar price, but the basic funda is same. And when the economy starts improving, you see equities market will rise and gold price will fall because people will have less demand for gold. People will have more interest to invest into equity. So the gold price continues to fall. As and when the equity market started to recover, gold prices fall. Now also gold is trading at a very low level. What is the level? Around $1,200 per troy ounce. And what is the gold price per 10 grams right now? It is 30,000, around 30,000 or around 29,000 something per 10 gram. But stock market is at a very high point. So whenever you will see there is any huge economic negative event having a negative impact on the company's future earnings, people will shift money from the equities and debt to gold. And whenever they will see that the scenario is improved in the equities market, then they will start dumping gold, they will start selling gold, bringing the price down. Now the gold price is down, but you cannot use this, as Mr. Manoj has said, mainly due to stock market correction. You can use it only to park your surplus money. Whenever there is correction, it is not due to stock market correction, but it is after the stock market correction you can shift your money. You can use the gold in that way. But gold cannot be used to beat the inflation. You see the 10-year price of gold in 2007, early 2007, what was the gold price? It was around $700 per troy ounce. Now it is $1,200 something per troy ounce. So in a span of say 10 years, what is the rate of growth in the case of gold? From 600 to 1200. But what is the CAGR if you want to see? Do you think it is able to beat the inflation? Let me show you. Let us use the Excel function of rate. Essentially, we are going to try to find out the compounded annual growth rate of gold. Is it good enough to beat the inflation or not? In how many years we said? In 10 years. Since we are taking the data from 2007. So let us type out as 10. PMT is nothing. We will type it as 0. It is not periodic outflow, periodic inflow. Had we entered at 600 price, that is the present value. Future value, that is around 1200, that's the price for today. Type is nothing, and just to close the bracket and type enter. So what is the rate of return in the case of gold? In the dollar terms, that is 7%. Sorry, 7.18% to be very exact. And what is the rate of inflation during all these years? Government figure might be 3%, but do you think in real life, whatever we see the prices in all around us, what could be the rate of inflation? Can you just type out your answers in the chat box? What could be the rate of inflation which you are facing in your real life? Okay, 8 to 9%. So if it is 8%, at least I'm taking a very conservative figure, then has gold been able to beat inflation? It is a clear no. Clear no. And what about equity? What about equity? Let us go to the equities and plot it on the same time frame. Just check out the levels. We are doing it, I want to say we are just taking the rough figures, but of course you can do it with the exact data also. Yeah, we have taken the data for 10 years. So 10 years back, this was around 15,000, not even 15, but it 14,000 something, and today it is 31,000. So if we just do it the same way, we calculate It is for 10 years. PMT is 0. Present value, we can take 14,500 since the graph was showing a bit below 15,000. Future value 31,500 and type and all. So at least equities, although it will show you a bad picture, but actually it is not that bad. At least you will be having returns at par with inflation. Sometimes this can also be inflation beating returns, but at least in this case you have managed to stay at par with the inflation. But trust me, this is not that bad because equities return is tax free, gold return is taxable. So still you have the consolation that equity return is the best return. This is what the historical data shows us. Okay, Rishabh had a question a while ago which he had written. Does the gold import also affects the price of rupee? Of course, it also impacts the price of the rupee. The more we import, this is my answer to you, Rishabh. The more gold we import, or the anything which we import like gold or crude oil, any such thing, more our quantity, more our import bill grows. There will be huge pressure on our foreign exchange reserves to pay for the imports. Thus, our foreign exchange reserves will come down, and automatically our rupee will depreciate. So, if you import more gold, going to I would say due to more demand by the Indian people, if you continue to import more and more gold, our foreign exchange reserves comes down and our Indian rupee depreciates. Is it okay, Rishabh? Are you able to understand my reply, or should I explain to you again? Okay, Rishabh has the reply. So I can see a correct connection. When the economy is down, we shift to gold and import more gold. So rupee depreciates, correct? So that it affects the stock market even further. Yeah, but that will, of course, it will be affecting the stock market, but it will be for say a few months or for 1 or 2 years. So ultimately, time will come again when the economy will start improving. I mean to say when the company's profits will start improving due to the lowering of the RBI monetary policy rates. That is the repo rate and reverse repo rate. You must be aware of this RBI policy tools. Whenever the economy does badly and rupee is depreciating, then what governments are doing, they try to help the companies to survive and also to grow by making the cost of capital down, by bringing down the cost of capital. So again the company's cost of capital comes down. If the RBI is going to reduce the rates, then company's cost of capital comes down, company's profit increases, but that will happen only after a time lag. So whenever you see that the gold price is up and equities markets are down and the rupee is depreciating, that's a good time to buy actually. Practically speaking, you should buy at those times. Of course, you understood the connection very well. That is good. Mr. Shriram has written one point, equity is taxable. Mr. Shriram, can you please tell under what circumstances do you think the equity is taxable and gold is non-tax? How come you are having such notions? Can you please clarify? Then only I can be helping you. Okay, you are not okay. You are not okay. You are not sure, but you are asking me. Okay, I tell you, gold is a fully taxable commodity. Please be informed. Gold is fully taxable, and equity is taxable only if you are holding for less than 1 year. If you hold the equity for less than 1 year, then it is 15% tax you have to pay on the capital gains. And if you're holding the equity for more than 1 year, then you don't have to pay any tax. And in my example, I had used the time period of 10 years. So 10 years is more than 1 year, wherein you don't have to pay any tax. Whereas in the case of gold, you have to pay the tax as per your tax slab. Okay. Any more questions? Mr. Manoj has written a comment. In case of short term, it's taxable. Okay. Okay, good. So we were discussing about gold and stock prices. So I just shown you, Mr. Avijit Bakshi, that as per the gold, equity prices rise and fall. Actually, you can say, Mr. Avijit Bakshi, that gold is having a negative correlation, or gold is having an inverse relation with the equities. If gold prices rise, the stock market falls, and if equities rises, that means people are more moving towards the equities part. Then demand for gold falls, and subsequently gold price rise. Subsequently gold price falls. That's the inverse relationship. Okay. You have got any questions from the book? Any topics you want me to clarify? Please ask. Apurva, Ramesh, Mr. Shiva. Okay, finally I have a question from Apurva. We still have to pay tax when we sell equity. Isn't it either capital gains or trading profit? Just I'll show you with the help of an example. Say if I had bought MRF 1 year back, if I had bought MRF 1 year back, so suppose what was the price of MRF 1 year back? Just let me give you some historical data. I'll use this. I will use this website called Value Research Online. Those who have been attending my webinars, I think they must already be knowing this website. The rest can just start following. Go to this chart. Alphabetical order, they are giving the name of the stocks. You can see on the screen the chart of the MRF. What was the price of MRF around 1 year back? Price of MRF, that is the red line, 31,317. So had you entered at 31,317 and you would have exited right now, say I would say within 1 year, then what was the profit? 70,000 nearly minus 31,000. 70,000 minus 31,000. Nearly 39,000 rupees you have made as profit. So in this profit, you will have to pay 15% tax. That is only if you exit before 1 year. But if you had exited at such point of time when in your period of holding had crossed 1 year, then you don't have to pay any tax. So essentially you have to pay tax on what, Apurva? It is not on trading profit, but it is better known as the capital gains. Capital gains is nothing but trading profit or investable profit. It is just the different terms, but they all mean the same. Whatever kind of profit you have made. Is it clear, Apurva? Capital gains means either trading profit or investment gains. Investment is when you make the profit after holding for more than 1 year. If you make the profit by holding less than 1 year, then it is known as trading profit. And together we call it a common term like capital gains. Okay. Dr. Vijit has a question on DDT. Okay. And Shriram has comment like, when every stock go up and down as per stock, income tax is applicable. It is not when every stock goes up and down, Mr. Shriram. It is as per your stock price. I mean to say as per your purchase price. The point at which you had entered. Suppose, just we take the example of MRF. You had entered around November 2016 when MRF was trading at 53,000. And if you exit it right now, now the stock price has increased a lot. It is now 70,000. Okay. So just because the stock price has risen, you are not going to pay tax. You are going to pay tax whenever you exit, whenever you sell it. And whenever you sell it means what? That brings us back to the previous topic which I was just discussing. What is your holding period? If your holding period is less than 1 year, you pay 15% tax. If your holding period is more than 1 year, then you don't have to pay any tax. Now are you clear? Mr. Shriram? Okay. let me get to the query of Dr. Abhijit. DDT. Okay, Mr. Abhijit, can you tell me what do you want me to explain about DDT? Any particular queries in DDT, because DDT itself is a vast topic. Please type in the chat box. Please put off your background noise. Okay, concept. I'll explain it. Guys, please put off your mics. Somebody's mic is on. I will explain. Just a minute. As you can see on the screen, what is the dividend distribution tax? Our government had levied this tax, which the companies have to pay whenever they declare the dividend to the shareholders. So they will be declaring a gross dividend. Say if a company's share price is rupees 500. Okay, this is the CMP, and face value is rupees 2. That can happen. We all know face value can be from rupees 1 to until rupees 100 also. And company declares a dividend of what? Say 10%. Let us make it 20%. Company declares a dividend of 20%. Now this dividend will be calculated on what? It will be calculated on the face value. Okay. So 20% into 2 rupees. So per share you will get 40 paisa. But this is the gross dividend. This is the gross dividend. So either you can calculate the dividend distribution tax on 40 paisa, or either you can straight away calculate on 20% also. So actually companies will be deducting the dividend distribution tax, that is at the rate of 15% on the rate of dividend declared. So effectively what dividend you will be getting is 15% less, 15% of this. Nearly 3 rupees or 3% will be going out to the government right at the stage of dividend distribution, without coming to your hands. Whenever the company declares the dividend of 20 rupees or 20% for that matter, right at the stage of distribution, they will just deduct the tax and give it to the government, so that you don't have to pay it. Whatever you will receive the balance, that is tax free in your hands. And what are the rules regarding that? Rules regarding is that the companies have to compulsorily, they have to deduct it. Okay. And further, 1 year back in the budget, the government had declared this rule. Government had made this rule. You can see on the screen. I'm just trying to highlight it. Those investors who have earned dividends of more than rupees 10 lakh in a year will have to pay additional tax of 10%. So already the DDT is 15%. Now if you are getting more than 10 lakhs dividend, you will have to pay 10% extra. So you will be paying 25% DDT. So anyway, the dividend distribution tax, after paying the DDT, whatever you get, that is tax free. But before DDT, I mean to say, before getting the dividends, the tax is deducted right at the company stage, at the initial source, and given to the government. So actually the equities return is not tax free. This is just to appeal to the concept of Indians. Yes, actually yes. 10% is on the excess amount. It cannot be on the entire of 10 lakhs. Whatever be the excess amount. So what I was just saying, that it is just to appeal to the Indians that the rules have been made such, the wordings are such that equity return is tax free. If you talk about capital gains, it is really tax free. But if you talk about dividend profits, dividend is not tax free. It is tax free only when it is coming to your hands. But before coming to your hands, you can see on the screen, as I explained to you, the DDT at the rate of 15% is already deducted by the dividend declaring company. So how come dividend is tax free? It is just the game of the language. Dr. Vijit, are you through with the concept of dividend distribution tax? You still have any doubts? Why DDT needs to be paid? Okay. Okay guys, you have any more questions? Should I continue with my own topics about the macroeconomics? I'll just show you some more data about the foreign exchange reserves. Now, what kind of foreign exchange reserves do we have compared to the whole world? What is the kind of reserves which India has? It is $381 billion, as you can see on the screen. You can follow my cursor. $381 billion. And this is a weekly data, mind you. Every week in the newspaper, in TV, you will find this news coming. In some week, it might happen that our reserves have grown. Our reserves have grown higher at a higher rate than the previous week. Then, as soon as this data comes that our reserves have grown, at that moment the Indian rupee becomes stronger. Equity markets also rise. I mean to say they have a tendency to rise. It is not sure shot that they will rise, but it should rise logically. And in 1 week, if you see that compared to the last week, this week the reserves have fallen due to the rupee depreciation or due to huge payment for imports, then our reserves will fall down and rupee also falls down as soon as the news come. Compare the Indian reserves with the China and US. I'll just show you the data. What is the kind of reserve of China? How many billion or trillion does China have? I hope you are able to see the screen now. What are the kind of reserves that China has? It is 3 billion, 3 trillion, what? Correct, it is 3 trillion. And where are we? 381 billion. So we have a long way to go. And why this is so? Why do we find ourselves in a sorry state of affairs? Because we are net of importers and China is net of exporters. China is an exporting oriented country. We are an importing oriented country. We do not build up our reserves that faster. Our payments are much more faster, but our inflows are much slower. We don't export a lot, but China exports everything. That is where we stand. Let us check out another country, United States. US reserves is how much? What is the kind of what are the kind of reserves which US has? Shiva, Vaishali, are all of you there or just listening? No questions? Rishabh, we are not talking about this cash conversion cycle. We are talking about the foreign exchange reserves, which has got nothing to do with the cash conversion cycle. This is based on the calculations of imports and exports. Whenever we import, there is an outflow of the foreign exchange reserves. Whenever we export, there is an inflow of the foreign exchange reserves. So this is based upon the net of calculations, net of inflow and outflow. You can see the difference. 1.2 trillion is the reserves of US, but the largest reserve is held by China. You can practice, you can go through this website, you will find a lot of data. So even after reading your books, if you want to really apply your knowledge, you can go through this website. You'll find a lot of data really. In the case of commodities, I'll just show you one more data about the gold. Gold price is now what? $1,256 per troy ounce. Okay. And what was the highest level? What was the highest level which gold had touched? That was $1,898 per troy ounce. That is nearly $1,900 per troy ounce. And when was it? It was at the height of the economic recession way back in 2008-2009. Whenever there is economic recession or any such negative economic impact, gold price rise because of the huge demand. People start to rush towards gold. They want to seek safety. They want to seek safe haven instrument. And that time equities were at the lowest point. Our Sensex had become 8,000. Today Sensex is what, 31,000 something. That time Sensex was at 8,000. Just imagine the kind of returns you could have made. Just imagine the kind of returns. If you had invested at 8,000, and now it is 31,500. It is actually in 10, not exactly in 10 years, but it is a little less than that. So you would be getting this type of returns, more than 16% return. That is taxable or tax free? Mr. Shriram, Rishabh, can you tell me, these equity returns which you are seeing on the screen, is they taxable or tax free? Tax free, great. This is a tax free return. So do you like tax free return or do you like taxable return? The choice is yours. Gold is there, but gold is not good because it doesn't have the power to beat inflation. Here, in the case of equity, you will get, what to say, real positive returns. How come I am using this word real positive returns? Because even if you take out some returns, some inflation rate also from this rate of equity, you are still having a positive 8.5, nearly 8.5 percentage points you are having after tax, after inflation. If you deduct the tax rate from the gold return, you will be having negative returns. But from equity, you are getting positive returns. That is why I am using this word positive returns. I hope all of you are clear about this concept. Okay, let us go out and check out some more indicators like interest rates. Since we are studying about the macroeconomics only. Okay. Now our repo rates are what? It is at a level of 6.25%. What is the repo rate? I am using this word. Who will explain to me what is the repo rate? Anybody? Any volunteers? Shriram, Shiva, Rishabh, can you please explain what is the repo rate? I am using this word again and again. I am using this word before also. No, I am not asking you the rate. What is the repo rate? I mean to say, can you please explain me the definition? Rate is 6.25. Correct. Rishabh is right. The rate at which banks get when they keep. Oh, sorry. Rishabh, you have just you have just reversed the definition. It is the rate actually at which the banks have to borrow money from the RBI. It is not the rate at which banks get. That is the reverse repo rate. If you are running a bank, say if you are operating ICICI Bank, whenever it needs money, it will have to borrow money either from the common public via bank deposits or it will have to borrow money from RBI. So whenever it will borrow money from RBI, RBI will lend money to the banks at a rate which is known as repo rate. So you can see what has happened to the repo rates in the last 5 years. I clicked on the 5-year chart. 5 years back, our repo rate was as high as 8.5. You can see on the screen. Everybody is following me? 5 years back, our repo rate was 8.5. Because 5 years back, as per the government data, inflation was very high. So government had deliberately kept the repo rates at high. Whenever the inflation in the economy is very high, demand for money is very high, then to prevent the economic crash, government always increases the repo rates. Our repo rates will be on the higher side. Because if the repo rate is higher side, just understand, if RBI has kept the repo rate at 8.5, that means what? Essentially RBI will lend money to the banks at 8.5. Then after some costs, administration cost, and after keeping their commission, after keeping their interest income, government actually the banks will add up some mark. Government will, so very sorry, all the banks will add up some kind of margin. To maintain their margin, banks will add some percentage points to 8.5%, because 8.5% is their cost of money. It is their cost of funds. So let's say they will add 2%. So 8.5% plus 2%, that makes it to 10.5%. Now 10.5% will be the lending rate to the corporates, that is to the companies as well as to individuals. I'm explaining the effect, why it will change, when it will change. Just let me finish the thing, you will get your answers. So what I was trying to say, when the RBI has increased the repo rates to 8.5%, banks cost of money is 8.5%. After adding the margin of 1 or 2%, it will become 10.5%. So banks will, yes, correct, Rishabh. For banks, the cost of borrowing will increase. So they will have to do the lending at a higher rates. That in turn will bring down the demand. If the demand is lesser, then all the projects getting postponed. Company's profit also decreases. Inflation also falls. And unemployment increases. So our economy starts cooling off. Our GDP also starts cooling off. You can plot the graph with the GDP graph which I shown you earlier. So whenever the economy is getting heated up, high inflation, companies are making huge profits, everybody is getting a huge salary increment, people are changing jobs very easily. That time, to prevent economic crash, government increases the repo rates. So ultimately within 2 or 3 quarters the effects starts pouring in. Equities are down, inflation is down, demand is down, GDP is down. Then again RBI will start lowering the rates even further to boost the economy. This is just like a rate cycle. When will RBI increase the rates? When will RBI decrease the rates? It all depends upon inflation and the money supply in the economy. Now if the RBI thinks that economy is down, actually economy was down towards the end of 2015, as you can see on the chart. We are roughly standing at the point of 2015 end, when the economy was down due to the not demonetization, but due to the other reasons the economy was down. In 2016 also economy was down. So our government wanted to boost the economy by lowering the rates, by making the cost of capital cheaper for the banks. So now banks can borrow from RBI at 6.5%. They can lend at say 8.2, at 8.5%. You will find such lending rates nowadays in the market. If you go to any bank, if you approach any bank for any corporate loan or any home loan, they will give you around 8 to 9%, because their cost of fund itself is very cheaper. Why is the RBI doing so? Because the government has said to RBI that you have to boost the economy, you have to increase the money supply. So if money supply increases, all the companies can borrow at cheaper rates, they can start new projects, they can generate more employment. More employment means more money in your pocket. You means what? The new workforce who is joining every year, every month. So when you have more money in your pocket, more employment coming your way, then you will start spending and our economy's GDP improves. So right now we are at this stage. Our rates is lower and so is our inflation, because our inflation has been controlled to a large extent. In the last 2-3 years, RBI repo rate was very high. Government has systematically brought it down in order to boost the demand. Government inflation is very low, although our inflation is 8 to 9% as we had just discussed, but government inflation is very low due to the government's policies. So now the government will start thinking, say after 1 year, this is my own analysis, my own view, after 1 year, maybe after 1.5 years, RBI will start increasing the repo rates again. From 6.5, it may go down further to 6 months, but afterwards it will start rising to 7 and further next, as and when the inflation starts rising again. Then again the equities will start fall. Then again the equities will start falling. Okay. Apurva has a point. This rate is still higher than Western world, then why would multinationals borrow from Indian banks? Multinationals anyway they do not borrow. The largest borrower, if you analyze the bank sector data, who are the borrowers? It is mostly the Indian companies, the Indian people. Multinationals they already have tons of money. I will show you why they have tons of money. Go to the interest rate tab. In the US, the FIIs, foreign institutional investors, I am talking about the FIIs or the multinational as per your language, they can borrow from the US Federal Reserve, that is their RBI, at 1.25%. They do borrow at 1.25%. They cross their country's borders, they enter into India, convert into dollars and invest into our equities markets. Because their cost of borrowing is still very low. Plus they will incur the cost of conversion when they enter. Again, when they exit our market, still they will have a cost of conversion. Still they will be able to make money much more from the Indian markets compared to their own markets. You talk about the Europe, let us check out some European data. What is the interest rates in the US, in the European zone? You can see on the screen. What is the rates? France, Germany, they are having what? 0%. UK is having 0.25%. So anybody can borrow from these countries' federal reserves or whatever the central banks are at 0%, at 0.25%. And why do you think in the first place these countries are having 0%? Can anybody tell me the reason? How come these countries are having 0% lending rate? This is their repo rate, I mean to say. What could be the reason for such a low rate? Apurva, you have any idea? Vaishali, Shriram? Of course, economists in doldrums. That means there is no demand for money. There is no inflation. Because they want inflation. They have excess of money already as a result of side effect of the actions taken in 2008 crisis. They don't have inflation, but we have lots of inflation. So wherever there is inflation, that means there is the demand. There only growth can happen. That is why all the FIs will come from UK, will come from Europe, will come from US and invest into countries like India. Because here we have plenty of growth, plenty of inflation, plenty of huge population. That is why east or west, India is the best. I'm not selling India, but I'm selling you the economic theme actually. Don't get me wrong. Just trying to explain to you the concept. Shriram has a point. They have a lot of money and good and service and less population. Correct. They have a lot less population, but we have a lot more population. But the negative point with our population is that most of the population is unskilled and their population is skilled. That is why their GDP is more than us. The GDP base size, I want to say. Now, where does the US Dow Jones stand? If you click on this 10-year graph, in 2007, it was roughly at what level? 12,000 something, 12,500 it seems. Apurva has a point, just a minute. but then inflation is not good for Indian people. I think if things are cheaper, people will generally be happy. Not sure much higher inflation is good for which economy. It's a classic case of tug of war. You have played sports in your school. Remember in school we used to have this game called tug of war, where two teams are standing at the opposite end of a huge thick rope and pulling it towards themselves. Obviously any one team will win, but actually it is always a constantly tug of war between the two teams. I want to pull my rope, I want to pull the rope towards my end, you want to pull the rope towards your end. So in practical finance world, who are these two teams? Who are these two teams? Two teams is of demand and supply. In our country, we have a population of more than 131 crores. Okay, population of more than 131 crores. So they create the demand. They will get the demand, and there will always be suppliers. Every company worth its salt, whether it be it an Indian company or whether it is a European or UK based company, their markets are already saturated and developed markets. They want new audience, they want new customers for their products. So they will be coming to India and they will be supplying at obviously at a profit. And since we have demand, they will not reduce the prices. Are you getting it? Whether any Indian company comes to do business in India or whether any foreign company comes to India for doing business, they are also coming here for profits, and when they are seeing that there is a good demand for products, they will not reduce the prices. So inflation will not come down. And usually all the developing countries have a high inflation, because wherever there is development, you would understand logically there is demand, and wherever there is demand, there is inflation, there is high price. So somewhat high inflation is good for the economy, but it should not be too low inflation, just like in the case of European countries, as I was just showing you the figures. In European countries and UK, it is very less inflation. Too much of low inflation is also bad. But if there is too much of high inflation, then obviously RBI will start raising the repo rates to bring down the inflation. That is the work of the RBI, to regulate the money supply and consequently to regulate the inflation and the interest rates. Apurva has a very nice point, which is the very relevant point nowadays in the media. 60%, it is not 50%, it is 60-65% who are into farming. High inflation is not helping anybody actually. It is only the rich farmers and the middlemen in the process who are making money. They are getting richer and richer. Every other day when you see news in the media that some farmers have committed suicide, and Indian government, or sorry, some state governments have waived off the farm loans. It is not the farmers who get benefited, but it is only us, the tax-paying population, who is getting hit. High inflation is not helping anybody. I mean to say consumer. I mean to say the consumers is not getting benefited anyway. It is good for the GDP, because overall it will be counted in GDP. Inflation is happening, that means demand is happening, GDP is growing. But actually on the reality, on the ground reality scale, if you talk, nobody is getting helped. It is only in the economical statistics you will show that yes, India is growing. So whenever the next time you will see in the media, India is growing, India is shining, be prepared to pay even more prices. Just now you must be knowing that GST is going to be implemented. So GST is said to be helping the Indian GDP to grow by at least 2% over the long term. In the next 5 years, we might be seeing GDP growth rate growing from 5% to 7%. Or if it is 7%, then it should become 9%. How come the GDP will grow? Because demand will grow, and demand will grow means what? Inflation will grow. And how can you hedge yourself against the inflation? You have to buy the equity shares. That is the name of the game. Mr. Puru, I hope I am able to convey you the message. You cannot beat the inflation. You cannot escape the inflation, but definitely you can face the inflation by investing into equities. Okay, I was just trying to show you the figure, the growth figure of the Dow Jones, that the US stock market index. In 2007 it was around 12,000 levels. Now it is at what level? Around 22,000. Let us check it out. What kind of growth is there? Although it is strictly not Indian equities law, but still you can conclude here. 2007, it is 10 years. What is the kind of growth rate? If anybody had invested into the US stock market, I'm not talking about whether the returns are taxable or tax free, leave alone that matter. Before tax, what is the gross return from the US stock markets in last 10 years? That is 6.25. And what is the return from our stock market in last 9-10 years? That is more than 15%. So where do you think the FIIs will come? If they have the brains, where they would be logically coming? Which country will they go to? They will borrow from the US Federal Reserve. They will borrow money at 1.25% and invest into US or invest into India. This is our equity. Do you see the picture? Mr. Shiva, Mr. Shriram, Rishabh, Vaishali, Mr. Manoj. Are you having a bird's eye view of the entire data point, inflation, interest rates? That's the kind of returns our stock market can give. It has given in the past, so it might be repeated also. Not to the same extent, but maybe around 12-13% we can get the returns, provided you stay invested into the markets. Okay, you have any more questions? Please ask. I see Anku Goel has joined us on the web. Hello Anku. I think your name is half spelled, so I'm calling you Anku because your name itself is showing here as Anku. Anyway, don't mind. So Anku, you have any questions? Please ask. No questions? I will also show you one more figure of gold reserves. What is the kind of reserves which US has? US has 8,133 tons of gold reserves. That's a very high figure. Actually, US is supposed to be having the highest gold reserves in the world as per the official data. What about India? India has only 558 tons, but this is the official figure, mind it. Do you think that Indians are so poor? 558 tons only. Shiva, what is your opinion? Do you think that we Indians are so poor? US is having more than 8,000 tons of gold and we are having only 558 tons of gold. Correct. We Indians are still the golden bird, as we say in Hindi, Sone ki chidiya, but it's a different matter that gold is present in households and temples. But official data, we are talking about the RBI, we are talking about the central banks. The US central bank has the highest gold reserve. We have a very low figure. Our RBI does not have that much of gold. It is only 558 tons of gold. Even China has more than that. And mind you, the first topic right at the start of the webinar which we discussed, gold price. Gold price also rises and falls due to the demand from the central banks. The central bank of every country like China, Japan or India or Taiwan for that matter, the central bank of every country also buys and sells gold, but not on a daily basis. But whenever they see that the gold price has crashed, they have to build up the gold reserves for the country's economic future. Then they will buy gold. They do buy gold in huge quantity, and whenever they sell in huge quantity. So the central bank's buying and selling actions also sometimes leads to the price rise and price fall of the gold, and subsequently it will affect our Indian rupee also. Okay, you can also explore these tabs at your own leisure time. Mr. Anku, you have any questions? I'm assuming your name to be Ankur. Ankur Goel, Apurva, Dr. Bakshi, you have any more doubts? Please ask. Apurva has a point. It is a bit unfortunate that these FIs can borrow at low price and can create market. However, locals have to cover such monster cost of interest while investing. Is RBI doing anything? You see, at least now, the thing which you are calling as monster cost of interest, just now the monster cost of interest is what? Still you can get to book bank fixed deposit at the rate of 6.25%. But if India also becomes a developed country like US one day, suppose, just you can have a future vision that 100 years from now, 50 years from now, if we do become developed at all, if at all, like US, then we will also be having those kind of interest rates in our country: 1.25, 2%, 3% bank FD return. You already have 4% savings bank account return, isn't it? So you can have same kind of returns from the bank FD. Then banks will be able to lend at an even cheaper rate. I will just show you the website of RBI. It will make the picture more clear. What is the lending rate? Nowadays, banks will lend you within the range of the 7.75% to 8.10. This is the MCLR rate, marginal cost of lending rate. Banks will not lend to you nowadays below 7.75, either within this range of 7.75 to 8.1 plus some markup based upon your credit history. So suppose now banks are lending at 8.10% to be very exact. If our rates are brought down by RBI to the range of 2% or 1.25, just like US, then these lending rates will also come down. But they will happen, I think, at least 50 years from now. Because India, again, as I told you, India is a huge population which has a created demand for almost all type of products, and huge demands will actually feed inflation. It will actually create inflation. So now I don't see, at least in the near future, rates coming down just like the US. It might happen in the, what do you say, in the very far future. And whatever is the future vision of RBI, you can track through the RBI policy. Whenever RBI comes out with RBI policy, say in the case of this minutes of the Monetary Policy Committee meeting, June 6th, you are aware, you must be aware actually, that every 2 months RBI comes out with a monetary policy. So you can explore this monetary policy wordings. Therein you will see what is the future vision of RBI. Are you following me, Mr. Apurva? If you want to really understand what is the future vision of RBI, you should track the monetary policy meetings come minutes. You have to see the minutes of the meeting. What is the resolution? What is the assessment? Where does our economy stands? You have to see the entire thing. But instead of going through the painful task of studying all these things in detail, you can find the gist of the RBI policy in the market. Whenever this RBI policy comes out, you will see a flood of reports coming from different brokerage houses to your mailbox. That itself should be good enough. There is no need actually to go through this. I am just showing you that from where you can get the data. There are different RBI governors giving their views on the RBI's, giving their view on the Indian economy. You can just go through that. You can see the gist. What is RBI thinking about inflation? What is RBI thinking about the monetary policy and supply in the economy? The entire view, the entire working is given there. What you just need to do is to explore. That demands a lot of work. Okay, I'm just closing this. See, as we were talking CRR of 4%, now we are having a CRR of 4%, SLR of 20 and half. I just spoke about CRR. I suppose all of you know what is CRR. Mr. Manoj, Mukesh, Ramesh, are you all knowing this? What is CRR? How does it affect? My question is, is to all of you. Although I took only few persons' name, but this question is an open question. Are all of you aware of these terms? CRR, SLR? It is. Yes, it is. Banks have to reserve means what? Banks have to give 4% of the deposits to RBI as reserve money. That is known as cash reserve money. So higher the CRR, lower will be the amount of liquidity left in the hands of RBI. Sorry, lower will be the amount of liquidity left in the hands of the banks for lending. So right now our government wants to boost the economy. So it is. Can you tell me right now if the government wants to boost the economy, what it can do to lower the rates? Either it can increase the CRR or lower the CRR. What steps? What step can it take logically if it wants to boost the economy?
We lower the CRR.
Correct. It should lower the CRR. So whenever they lower the CRR, then again, if the banks are good enough, now I'm using this word because banks are usually known not to pass on the full effect of the rate cut. Unless they want to pass on the full effect of the rate cut, the lending rates which you see on the screen, that will not fall much. And still the company's profits will not be growing much. And what is RBI doing about it? RBI cannot do anything about it. RBI can only bark, but it does not bite. Are you trying to understand what I'm trying to say? If you remember the story of Mahabharata, in the story of Mahabharata, there was the blind king, and whatever he said, whatever he shouted at the Pandavas and the Kauravas, nobody listened to him, nobody bothered. Similarly, RBI also, although it is the banking regulator, whenever it decides to lower the rates, banks are not good enough to oblige the RBI and pass on the full effect of the rate cut. Because whatever the banks lower the rates, it is only lowering the rate for the new borrowers. They do not pass on the rate cut effect to the old borrowers who have already borrowed at the previous higher rates. Why? Because banks want to maintain the net interest margin. That is how the banks grow. So what you can do in such kind of scenario, you can do only one thing: go and buy the shares of banks and all the lenders. So if you understand the banking system of the economy, you can understand actually how well is our economy growing, how good is the economy. I guess it is okay. Anybody has any more doubts, any questions? I would also request all of you to explore this website rbi.org.in besides the previous website of Trading Economics. Everybody okay with whatever I have been discussing? Any doubts, please ask. If I might have missed anybody's point, please type it out again in the chat box. Also, I'll show you something called economic calendar. You see in the home page of the Trading Economics, there is the economic calendar for major countries like US, UK, India. If you go to the India tab, here you will see on which date you are going to have which kind of economic data event happening. So yesterday it was the foreign exchange reserves which came in at the same level. Like the previous week also they had the same reserves, this week also they had the same reserve. There was no fall, no rise. They also had this data of deposit growth. Now whose deposit growth are you talking about? We are talking about the banking's deposit growth. The banks. Banks take the deposit from the common people. So what kind of deposit growth rate has happened? 11.2%. It is a year on year, so it is a yearly data. Compared to last 1 year, the bank's FD rates have fallen, but still we the Indians love the fixed income thing. Still we the Indians love the bank FD thing so much that the bank FD's base continues to grow even at a lower rate. 1 year back, bank FDs were giving us more than 7.5%. but now they're giving us 6.5%. But still we go and deposit money into the banks. We don't go and deposit money into the equities markets. Are you just seeing the picture? Where do we stand? Hello guys, are all of you listening to me? Are all of you enjoying the show of economic data? Okay, Shiva has a question to me. How to analyze mutual fund cash flow and effects on the equities markets? Mutual fund cash flow, not exactly mutual fund cash flow, but what I would ask you to track is this thing. So I'll just write it out. You must track what? You must track the inflows of the FIIs and DIIs. Now what are the FIIs? That is the foreign institutional investors. This is clear to you. FIIs means what? Foreign institutional investors. And DIIs means what? Under the DII category, you will find that there are several things like mutual funds, there are the trusts, there is the APFO. APFO means what? Employees Provident Funds. Also the banks, also the life insurance companies. These are all the under the broad category of domestic institutional investors. So mutual fund data sometimes you will get in the market, but broadly you should track FIIs whether they have sold or whether they have bought on a net basis. DIIs whether they have sold or whether they have bought on net basis. This is the data which you can track on a daily basis. I guess all of you guys are aware of our app, Stockage app. If you are operating our Stockage app, in the Stockage app itself you will find those data. How many of you are using the Stockage app? You can go to the home screen. Once you open the app, whatever the first screen comes up, in that screen itself you will find a tab, FIAs and DIAs flows. I would request all of you to go there and have a look. Therein the data is given. If you find on any single day that FIAs and DIAs have purchased a lot, I want to say the net purchase. Every day somebody will be selling, somebody will be buying. But what is the net impact? Net, whether they have purchased or whether they have sold. Obviously that will have an impact on the stock market price. That is how you can track. So you can just go to the app and practice. Mr. Shiva, is it clear? Are you using this Stockage app, Shiva? Okay, great Shiva. Then you can just go to the Stockage app. You can have your doubts cleared there itself. Any more questions, guys? No more questions? Let us go back to the economic calendar. I'll show you some more data. We were actually talking about the deposit growth rate. Below that we have the loan growth rate. This is a very, very important data. Just like the banks collect the deposit from the different people, from the common public, but why do they collect? Because they have to lend it further to the public at a higher rate. We have just seen the lending rates of the bank are ranging from 7.75% to 8.20%. But you can very well remember, you can make it out from your common day life that today's bank FD rate is 6.5% for anybody who is less than 60 years. So if banks are borrowing at 6.5% from the public and lending to another person in the public at 8.2 or maybe at a higher rate, obviously that is because of the bank's work. Bank's job is to borrow money and to lend money. So therein we are talking about the bank loan growth. What is the rate of growth in the loan book of the bank? You will see the loan growth is not that high. Compared to 1 year ago, our loan book is growing at 6%. The loan book, it should be growing at higher rate, no? Loan book, are you all aware of this term? Are you all comfortable with this word, loan book? Another word which they use in the media, in the newspapers, in the TV, that is the advances. Suppose if any bank says that it is having a loan book of 27,000 crore, that means it has lent so much money to the different people and to the different companies. So on that kind of loan book of 27,000 crore, what is the rate of growth in 1 year? In 1 year, how much more loan they have given? That is the rate of growth I am talking about. This loan growth rate is a good indicator. If the companies are growing, then only they will be able to demand credit from the banks, then only their stock prices can increase. So if the bank loan rate grows healthy over a long period, then it shows that our economy is going to improve. So these are very, very important economic indicators for you to track. Not only the foreign exchange reserves, but also the deposit growth and the loan growth rate. Are all of you following me? You have any questions till now regarding the gold, regarding Indian rupee, deposit rate, growth rate, RBI repo rates, RBI policy rates? Any questions you have? Is there any point which I might have missed out? Please ask me again. Hello, is it clear to you? Okay, next also you can see on the screen there are more economic factors, economic data. On 30th of June, there was this data like government budget, what is the value of the budget, what is the infrastructure output, foreign exchange reserves. Mind you, as I told you, we will have this foreign exchange reserves as a weekly data. That is why you will find every week having the same headline, foreign exchange reserves. So there are different data which you can just track: inflation, balance of trade. Do explore this website. It's a very, very informative one. If you don't understand any such thing, you can just click on it. They will also give you the explanation, when it was the highest, when it was the lowest, and definition. If you want to track, you can track from here. Like in this case, what is the PMI? I've deliberately shown you this index, PMI. PMI is nothing but Purchasing Managers Index. Short form is PMI. It is compiled by Nikkei India. Although Nikkei is the index for Japan, but they also work by the way of compiling different indices for different activities in different countries. So they compile this index called PMI to measure the performance of what manufacturing sector in different countries. So in our country, there are two indicators of economics growth. In our country, there are two indicators of the economics growth. Sorry, two indicators of the industrial growth, to be very, very specific. First is the IIP, second is the PMI. IIP is what? Index of Industrial Production. But this figure is calculated by the government agencies. This figure is not that exact. It is not very accurate. PMI is calculated by private agencies, and their figure is supposed to be much more accurate. They will show you the true picture if the industries in our country are growing. So if you want to know beforehand in which quarter GDP will come positive, in which quarter you can see good stock market price movements, then perhaps you have to study the PMI beforehand. So PMI is nothing but it shows the performance of the 500 manufacturing companies. It's a very, very broad-based index. Now these 500 manufacturing companies are spread across the different sectors, different goods and services. I'm going to say not services, but different items, different products. Now how do we read this index? This is the graph last 1 year. This is the graph of the PMI, India Manufacturing PMI. This, whenever you see this word manufacturing or service, whenever this word is written before PMI, that means this index is coming out with respect to the manufacturing sector. Sometimes you will see service PMI. That means that PMI is coming out with respect to the service sector growth. But now we are talking about the PMI measuring the growth of the manufacturing sector. So what is the growth of the manufacturing sector? This is a weekly index. Sorry, this is a monthly index. Very sorry, it's a monthly index. So in the case of monthly index, uh, please follow the graph on the screen. How do you know whether this index is showing you a good picture or a bad picture about the economy, about the manufacturing sector particularly? So 50 is a threshold. You can see on the graph it is 51, but actually 50 is a threshold. 50 is the line of demarcation. So if any year, if in any month you will see that the PMI is below 50, like it was around December 16. So in that month, the economy has contracted. And if the index is coming above 50 in any month, then above 50, the index shows that the economy is expanding. Are you getting me? What is PMI? That is Purchasing Managers Index. It is supposed to measure the growth of the manufacturing companies in a particular country. Although I am showing you the index for India, but you will find such indices for almost all the countries in the world in this website itself. So I'm just trying to tell you how do you decipher, how do you make some sense out of this index. What is the index figure? You see on the screen manufacturing PMI in the last month. I'm to say that in the June they gave this data. In the June when the PMI figure was out, our index was 51.6. That means in the month of May index has degrown, because in the month of April it was 52.5, but in the month of May it was 51.6. Are you all following me? Yeah, Mr. Hitesh, you have to search in the PMI section that what are those 500 companies or what are those sectors. You have to go to the website of Nikkei India. Then you can get into the more such details. So what I was trying to explore, what I was trying to explain to you is below 50, if the index comes, then that shows contraction. Above 50, if it comes, that shows expansion. So in the June, you will get the figure of for the month of May. In the month of May, you will get the figure of April. So compared to April, in the month of May, manufacturing sector has decreased. That is why you can say lower index. But just for 1 month, if you see the data, it is not a good idea to arrive at some decision. Rather, it should be at least 2 quarters or at least 1 year. That is why I've deliberately clicked on 1 year tab. In 1 year, the PMI has grown from 50s level to 54. Again, it came down to less than 50. Now we are back to somewhere between 51 52. So back to square one. It's almost like back to square one. Wherever we were 1 year back, we are almost at the same level. Not 1 year back, sorry, 1.5 year back. So we still have a long way to go. Also, let me tell you, RBI, whenever it decides to come out with the RBI monetary policy, the kind of which I shown you in the RBI website, they will not only see the inflation, they will not only see the all the profits which the companies might be making, they will also see whether the manufacturing sector is it growing. Because if the manufacturing sector it is doing well, then the PMI should be very high, but which is not so now. Now the PMI is very low. That means the manufacturing sector is not growing. Now what is the problem of the manufacturing sector? Problem can be say that the labor cost is high, or banks credit is not available. Banks are not ready to lend to the companies. Companies are still coming out from the effect of demonetization. So what the RBI needs to do, RBI needs to boost the economy by making the cost of capital lower for the banks. Sorry, by making the cost of capital lower for the companies. So it is already started reducing the rates for last 1.5 years. It has been reducing the rates, but still the companies industrial growth are not picking up. It's a matter of thinking, deep thinking to be done by RBI. In last monetary policy, they have actually reduced the rates by 0.5%. If anyone among you have been following this SLR rate, which I shown you earlier, SLR rate they have reduced. This SLR rate, which is now 20.5, you can see on the screen. This rate was before June, this was 21%. They brought down the rates. Why? Because they know that the economy is not growing that fast. So they want to lower the cost of capital so that companies can grow, industrial activities can increase, more hiring can take place. Are all of you getting my point? That is why PMI is also a very important factor to track. Are all of you okay with it? Whatever I've been explaining regarding the PMI. It's a very important index. Please do follow. If you want to make money from the stock market, you have to follow not only the inflation, monetary policy, but also the PMI. PMI is nothing but an indicator. Inflation is also an indicator, isn't it? Inflation, interest rates, RBS policy, foreign exchange reserves, all these are what? These are examples of indicators. Okay. Any more questions you have, please? Apurva has a very interesting question. What if the FIs are net sellers and DIs are net buyers? Nowadays, I find almost every day such kind of conflicting situation. How do we interpret the market in this case? Apurva, for this you have to just understand if India is any more attractive in the eyes of the FIIs. If the FIIs are having some problems in their home countries, like in US or in UK, then they will start selling their invested money in India and take the money back to their country. So they might be selling in that way. Or whenever if they think that the Indian markets are overvalued, stock market is right now 31,000 something, 32,000 something. So if according to their analysis they think that Indian markets are overvalued, they will become net seller. But if the DIIs think no, the Indian market is not overvalued, they will buy for the long term. So I showed you on the screen who are the DIIs. DIIs are mutual fund trust, EPFO, banks, life insurance companies. Life insurance companies, can you tell me what is the average duration of a policy? All of us have some kind of life insurance policy. For how long period do you buy the insurance policies? Can you tell me what is the duration of an average person's life insurance policy in India? At least it is 10-20 years. Isn't it, Apurva? Do we buy life insurance policy for short term or for long term? I think it's for long term only. All of you are correlating with me, no? Usually we take policies for more than 10-20 years. And banks have the net interest income, that is the treasury money, for the long run. Treasury income, that is surplus again for long term. Provident funds, also whenever we get our salary, from our salary provident fund money is deducted, that we can withdraw only at the time of retirement, and we usually retire at the age of 58. That's the government rule, before which you cannot take out your money from EPFO. So again, this money is for long run, for long term. Trust are also having money for long run, that's for more than 10-20 years. Mutual fund also, again this is can be both short and long. But FII's money is only for short run. FII's money is for short term. Why? Because FIIs like to invest money into India not because they like us. Please remember, FIIs like to invest money into India not because they like us, but because they find the Indian markets attractive for a particular period under consideration. So whenever they find that Indians market are not that attractive due to demonetization or due to the failure of the implementation of GST or any such economic factor which the government could not deliver, then they will start selling. But the DIIs, they have the long run money. You see, we provide money to the life insurance companies like LIC of India and other private insurance companies. We do take policies. Their policies money is deployed in the markets for long run. So whenever DIIs are investing money, it is a good signal Earlier, we were very much dependent on the FIIs, and there was very less presence of the DIAs. But now DIAs are a rising force. Although it is not a controlling force as of yet, but DIAs are also a rising force. When DIAs are buying, that simply means, Apurva, that we understand our own country. FIAs do not understand our country that much. Although we should be watching the data of both FIAs and DIAs, but just stop getting afraid of the FIS data. That what to do when FIS is selling. And of course, you can see the data of the DIS. No, when DIs are buying, that means something. That we Indians, we retail buyers have finally arrived through these companies, through mutual funds, through trust, through EPF, through banks, through LICs. That means something. We are going to grow. Don't worry. This is how you interpret the market. Actually, to say this is how I interpret the market. Okay. Guys, any more questions, or should we close the session for the day? It's almost 4. Okay, no more questions. Then can I close the session? Any more questions anybody has? Mr. Anku, Apurva, Hitesh, Manoj, Ramesh, Rishabh, Vaishali. Okay, nobody? Okay guys, bye. Thank you. Thanks for joining. Have a nice weekend.